Up traders, I'm Mark Bauman of StartTrading.com, and today we are talking about taxes. But before we get started, please leave this video a nice like by pumping that like button, a thumbs up, and if you haven't already, press that little subscribe button, the red button right down here. Now, 2020 has been a wild year. Man, with the pandemic forcing millions around the world into their homes, many people have time to trade now and new hobbies. No more going out. So what do? You trade. As many of you have seen, with the whole Reddit fiasco, stock trading and investing has become just more popular than ever. Now that's because more people have access to the financial markets, thanks to apps like Robinhood and WeBull and eToro, which you'll find in our SIG or Naga. Now, if you've been one of those people that started trading in 2020, there are some things you need to know as tax season gets underway. Save the Benjamins, or the Washingtons. If you live in the US, you'll be taxed on any profits you made off trades last year. Fun. So how will you know how much money you made? Well, whichever brokerage you chose to work with should have already sent you a form titled 10-99B-S. Those forms or documents track any losses or profits that you accrued last year. You can also download them out of the platform. So there's two types of taxes that you could be subject to. One is if you held an investment, such as stocks, bonds, or real estate, for less than 1 year. Then you will have to pay the short-term capital gains tax. More fun. That tax will be the same as your ordinary tax rate and could be up to 37%. That's quite a hefty load there. So what we're going to talk about is how to reduce that load. So now if you had any investments for longer than a year, then you'll pay the long-term capital gains tax, which is usually less than the short-term tax and maxes out at 20%, though most people pay no more than 15%. Now, what do I mean by locking in losses? Locking in losses means that if you're trading a stock and you have losses, such as might have happened more recently if you were in the tech dip that just happened, where you lost anywhere from 10 to 30% of your portfolio's wealth, you could simply sell those shares of the stock where you had losses, lock those in, and pivot into other stocks. Now, the only problem there is you can't buy back into those original stocks if you want to take the full amount of the losses deductible from your taxes. You want to stay pivoted out. But here's where the strategy comes in. As I've told you many times in my videos, always set trailing stop losses and always have a plan to buy something else. Because if not, and you set trailing stop loss, you have a plan to lose that money, whatever percentage that is. If you don't plan to lose the money, don't set the trailing stop loss. Or you could plan to buy something else. So if you transition into a different stock, you can lock in your losses, then that gets adjusted against your adjusted gross income at the end of the year, and you transition into a complementary company. So let's take, say, NIO and Tesla, or NIO and CCIV, which are probably more comparable. If you lost a bunch of money in NIO, why don't you just sell NIO? You can buy back in later. Don't worry, there's going to have its dips again. And you buy CCIV. Now, you don't buy NIO for about, I believe it's 3 months. And then when ready, watch for the dip in NIO and you get back into NIO. That way, if you didn't lose in CCIV, but you lost in NIO, or say you lost in both, you just choose one or the other, you lock in the losses with one, and you buy another. That way, you've locked in those losses, so you could deduct them from your taxes at the end of the year, and you've now repositioned yourself in an asset that has dipped just as much as the previous asset. Similar to when we talk about Forex trading and finding pairs, just like US and Euro, or US and Bitcoin. You want to transition to the other asset, lock in your losses. You can also do the same in charging companies, take Blink and SBE. You could do the same in tech companies, take CrowdStrike and the new roadblocks. It's your choice. But be wary of it, be conscious of it. I lost $100,000 1 year because of a big dip after I made $300,000 on a stock. I did not exit that stock, therefore I did not lock in my losses, and I did not realize that until at the end of the year when I was super excited about all these deductions, even though I had all these profits, but I had this $100,000 in losses I thought I locked in. But I didn't wait the appropriate amount of time, so make sure you look that up for how long until you should get back into the stock. And also, as always, consult a professional, a tax advisor, which I am not. Thanks for watching. Hope you liked the show. StartTrading.com.